I want to talk to you about the top 10 tax loopholes that could save you thousands of dollars. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. So today I want to talk to you about the top 10 tax loopholes that could save you thousands of dollars. We all know that the United States has a complicated tax code, right? So whenever you have something that complex, it is bound to have some loopholes in it. So the question of whether to close those loopholes pops up in election cycles from time to time. Because every loophole has someone to save money on their income taxes, it's always an uphill battle to eliminate them. So today I'm going to explore with you some of the biggest loopholes in America's tax system. Now, what makes a tax loophole? The thing here is that the basic definition of a tax loophole is a provision in the tax code that allows taxpayers to reduce their tax liability. So lots of benign deductions and credit do just that, right? The connotation of a loophole as something with unintended negative consequences is what makes loopholes controversial. And the funny thing about the politics of tax loopholes is that some people want to keep the loopholes that benefit them, but close certain loopholes that affect other people or corporations. All right. I'm not going to wade into the politics of what makes a loophole or a bad loophole or versus a good loophole. I'm not going into that. So let's first get into it. So here are the tax loopholes for low income earners. Some loopholes come in the form of tax credits designed specifically for lower income taxpayers. So two types of credits are available. So you have the refundable credits, which enable taxpayers to receive refunds even when they have zero tax liability. And then you have the non-refundable credits, which enable taxpayers to reduce their tax liability but does not increase their refunds. So low-income earners are eligible for both types, the refundable and the non-refundable credits, including the following three credits. Number one, you have the American Opportunity Tax Credit. So this is an educational tax credit that replaces and expands on the HOPE credit. So it applies for the first 4 years of college educational expenses and provides a tax break for expenses including tuition, books, and other supplies. So the credit is worth up to $2,500 per eligible student, and its most attractive feature might be the fact that you are refunded 40% of your total credit. This is $1,000 maximum that exceeds your tax liability. So in other words, what I'm trying to say here is that if your tax bill is $1,000, but you earn $2,000 in refundable tax credits, you are entitled to a refund of $400. In other words, 40% of the $1,000 that exceeds your tax liability. So calculating the credit can be complicated, but the IRS provides instructions both online and on the forms you will use to file your taxes. And the great thing here is that if you use an online filing service such as H&R Block, TurboTax, TaxSlayer, TaxAct, Credit Karma Tax, they'll do it for you automatically. All right. Now, to claim the full amount of the American Opportunity Tax Credit, you must have a modified adjusted gross income of $80,000 or less, or $160,000 or less if you're married and filing jointly. Number two, Savers Tax Credit. So the Savers Credit, formerly known as the Retirement Savings Contribution Credit, is specifically designed to help lower income families contribute to retirement plans. So if you qualify, this credit essentially pays you to put money in your retirement account. So you can write off the first $2,000 of contribution. That's $4,000 for married couples filing jointly. So if you make the first $2,000 you make to a qualified retirement plan, such as 401k or traditional or Roth individual retirement account (IRA). So whether you can claim the credit depends on your income and filing status. So to qualify, there are a few things you have to do though. You must not be a full-time student or be claimed as a dependent on someone else's tax return. and you must also be at least 18 years of age. So the adjusted gross income limits for claiming the saver's credit are as follows. So married and filing jointly, this is $64,000 for 2019 and $65,000 for 2020. Filing as head of household, $48,000 for 2019 and $49,000 for 2020. And other filers, you need to have the minimum, the adjusted gross income limits are $32,000 for 2019 and $33,000 for 2020. So the amount of your credit will be 10%, 20%, or 50% of your contribution, depending on your AGI. Next, we have the Earned Income Tax Credit. This credit was specifically designed to assist low to moderate income families. So even single taxpayers can benefit from the credit. However, income and the number of children in your household determine the amount of the credit. So the income limit ranges from $15,000 if you are single and have no children to $56,000 if you're married and filing jointly and have 3 or more qualifying children. So the maximum amount of earned income credit is around $6,500 for 3 or more qualifying children, around $6,000 for 2 qualifying children, $3,500 for 1 qualifying child, $529 for no qualifying children. So you must qualify for the credit by having business income or income from a job. So when you're claiming a qualifying child, they must be younger than 19 years old unless they are enrolled as a full-time student, in which case the age limit rises to 24. So those are the three main tax loopholes for low-income earners: the American Opportunity Tax Credit, the Savers Tax Credit, and the Earned Income Tax Credit. Let's talk about the tax loopholes for the middle class. So in general, income tax loopholes for individuals in this category are harder to come by, as phase-out rules make them ineligible for a number of credits and deductions. And many credits, as I said earlier, are designed to help out lower income taxpayers or pertain specifically to higher earners. However, some credits and deductions are still available to middle income earners. Let's talk about the mortgage interest deduction. That's one of the favorite for middle income taxpayers. Your best chance of scoring a big tax break is with your home. No question about it. So when you buy a home, you can claim the mortgage interest deduction, which allows you to deduct the interest portion of your mortgage payment, but not the principal, right? In other words, you cannot write off your entire monthly payment, but you can deduct the interest payments you've made all year with a qualified mortgage. The deduction can be a big tax saver in cases where it makes sense to itemize deductions, right? So when the amount of your mortgage interest deduction exceeds your standard deduction, you'll save more money if you itemize. So the standard deductions amounts are kind of the standard deduction amount have a big impact actually on whether or not you should itemize. And the amounts usually are around $12,000 for single filers or married filing separately, $18,000 to $19,000 for head of household, and $24,000 for married filing jointly and qualifying widows and widowers. So individuals age 65 and older and blind individuals qualify for an additional standard deduction, which is around $1,600 or $1,700 for single or head of household filing status, and $1,300 for married taxpayers and qualifying widows and widowers. The IRS, I just want to mention this, the IRS publishes extensive information on what a qualifying home is and who can claim the mortgage interest deduction. However, most standard mortgages qualify as long as the loan is for your primary residence and you are the homeowner. Very important, folks. We're not talking here about a secondary residence or an investment property. No, it has to be your primary residence and you have to be the homeowner. Let me give you two other tax loopholes for the middle class. So you have the lifetime credit, and then you have the child tax credit. The lifetime learning credit is an educational tax credit that is very similar to the American Opportunity Tax Credit. However, when you claim one of those two credits, you cannot claim the other for the same students. Unlike the refundable American Opportunity Tax Credit, the lifetime learning credit is non-refundable, so you can claim the lifetime learning credit for an unlimited number of tax years, whereas the American Opportunity Tax Credit has a 4-year maximum. And the Lifetime Learning Credit lets you claim up to 20% rather, 20% of the first $10,000 in qualifying expenses up to $2,000 per tax return to help offset the educational cost of a qualifying student. So the credit comes with the relatively high modified adjusted gross income caps. So it's around $134,000 if you're married and filing jointly, or $67,000 if you're filing as a single head of household or qualifying widower. The Lifetime Learning Credit gradually phases out for single filers with a modified adjusted gross income of $57,000 or more, and taxpayers who are married and filing jointly with the modified adjusted gross income of $140,000 or more. Remember though, folks, you cannot claim the credit if you are married and filing separately. And also, the tax credit is available regardless of your age, as long as it goes towards a qualifying educational expense. So acceptable expenses include tuition, student activities fees, course-related books, supplies, and equipment. And then we have the child tax credit. And this is for taxpayers with qualifying children, and they can claim this on top of their earned income credit and credit for child and dependent care expenses. So the child tax credit can be worth up to $2,000 per child living in your household, and it's partially refundable. So it allows you really to get back up to $1,400 even if you don't owe tax before claiming the refund, as long as your family income is at least $2,500. To qualify, you must file the child as a dependent on your taxes, and the child must have a social security number by the date on your tax return, be age 16 or younger at the end of the year, and be currently living with you for at least half the year. So a $500 non-refundable credit can be applied to eligible dependent who cannot be claimed for the child tax credit. So you might qualify for the full child tax or other dependent credit if your modified adjusted gross income is less than the following amount. So $200,000 for single filing status and $400,000 for married filing jointly. One thing I need to mention here is that both credits begin to phase out at a modified adjusted gross income of $200,000 or $400,000 for taxpayers who are married and filing jointly. I'll be right back right after this. Don't go anywhere. Welcome back, folks. We're still having a conversation here about the top 10 tax loopholes that could save you thousands of dollars. Let me talk to you now about the retirement savings account. This is another tax loophole for the middle class. Although taxpayers at all income levels are eligible to contribute to retirement savings accounts, the tax benefits are typically more accessible to middle income earners. Low income taxpayers often cannot afford to contribute the maximum amount to retirement accounts, and high income earners are ineligible for tax breaks on certain accounts. However, one thing I want to say here is that the benefits can be huge for those who can afford to contribute to a retirement savings account, because contributions to employer-sponsored 401k plans and individual retirement accounts are eligible for tax deductions that can reduce your total taxable income. Let me give you an example. Let's say you contribute $5,000 to your company's 401k plan. The amount of your taxable income will drop by $5,000. And if you are in the 25% tax bracket, guess what? This amounts to savings of $1,250 in federal tax. $1,250 meaning 5,000 times 25%. So retirement accounts offer more than just an immediate tax benefits. As long as you keep the money in the account, it grows tax deferred. So for a regular brokerage account, you would owe taxes annually on dividends and capital gains payouts. But if you have a retirement account, you pay taxes only when you make a withdrawal from the account. So contributions to a Roth IRA don't qualify for a tax deduction at the time you make the deposit. Rather, you withdraw your earnings and contributions tax-free once you are 59 and a half years old. And Roth IRA's contributions come from post-tax income, and in other words, you pay taxes on your income now, but not in the future, which could be very interesting depending upon your situation, right? And you don't get the immediate tax break for Roth IRAs like you do for pre-tax accounts like traditional IRAs and 401k plans. All right, now let's talk about the tax loopholes for the rich. First, you have the the capital gains tax. So although the capital gains tax loophole is available to taxpayers of all income levels, it benefits high income earners or filers in the 25% or higher tax bracket the most. The reason comes down to the progressive nature of the tax system. So the special tax rate on capital gains is beneficial to high income earners because the tax, if you really think about it, the tax on long-term capital gains and dividend income for most taxpayers is 15% to 20%, depending on their income level. And exceptions include a higher 25% tax rate on something called unrecaptured Section 1250 gains, which is a type of depreciation recapture income realized on the sale of depreciable real estate, and the 28% tax rate on the sale of collectibles or small business stock. So meanwhile, the tax rate on a higher earner's ordinary income can be as high as 37% for the 2020 tax year. So this disparity in rates can translate to great tax savings. Another tax loophole for the rich, you have the high income mortgage interest deduction. And the mortgage interest deduction for middle income earners can benefit high income earners even more at tax time. Statistically, higher income earners are more likely to itemize deductions than take the standard deduction, right? That makes sense. Additionally, higher income filers tend to have larger mortgage payments, which increases the potential amount of their mortgage interest deductions. In addition to the mortgage interest deduction, you can deduct the interest you pay on a home equity loan used to build, buy, or substantially improve the primary or secondary home you are borrowing against. So the only caveats here are that the home equity loan and first mortgage cannot total more than $750,000, and the total loan amount cannot exceed the cost of the home. And there is more good news. You can deduct up to $10,000 of property tax or $5,000 if you're married and filing separately. And the last tax loophole that could save you thousands of dollars, and this is one that is kind of cool for the rich. You have a carried interest loophole. So this is the carried interest loophole basically applies to high income taxpayers. So I'm talking here about venture capitalists, hedge fund managers, and partners in a private equity firm. Those are eligible for special tax treatment based solely on their occupations. So the carried interest loophole is a variation of the capital gain tax benefits. So paid compensation in these professions is considered a distribution of investment fund profits, which is called carried interest. Because this income is regarded as an investment profit rather than a salary or wage, it is taxed at the long-term capital gains tax rate instead of the regular income tax rate, which can be significant for those in high income tax brackets. Let me give you an example. I want to break it down for you. For example, a $1 million salary will be subject to the 37% tax rate plus a 3.8% net investment income tax, which will come out to be $408,000, right? So that's the tax. When salary is considered carried interest, however, that same $1 million will be subject to only the top 20% capital gains rate plus a 3.8% net investment income tax, which will come out to $238,000. So think about $408,000, that's the first scenario, and $238,000 in the second scenario. That's very simply here a gain of $170,000. All right, folks. This was it for today. I really appreciated your attention. Thank you so much for sticking around. So here are the top 10 tax loopholes that could save you thousands of dollars this tax season. So we have the tax loopholes for low-income earners. So we have the American Opportunity Tax Credit, the Savers Tax Credit, and the Earned Income Tax Credit. And then we have the tax loopholes for the middle class. So you have the mortgage interest deduction, the lifetime learning credit, the child tax credit, the retirement savings account. And then you have the tax loopholes for the rich. So you have the capital gains tax, the high income mortgage interest deduction, and the carried interest loophole. I will speak to you another time, but until then, remember, stay marvelous.